Hey, Steve.
Paul Nino, how are
Nice.
you?
Good. Nice beard.
Thank you. It's sticking around a little longer. My daughter wants me to make it into a mustache, so we'll see. I've never done that, but
Yeah, it is starting to look even like you could start to wax it and Raleigh to go for the Raleigh fingers look if you wanted to.
you think? Wow. All right, that
I
would
mean,
be
not cool. I mean, obviously nothing. It's you're not going to be getting the loops that
yeah.
Raleigh finger had yet, but I mean, if you put your mind to it, Steve, I think you could accomplish that.
I'll be like,
It's a worthwhile goal.
yeah. I'm a goal setter, Paul.
I had yeah. So it's your vacation beard. I did the same thing, but I couldn't leave it like you have. Frankly, you look better with it than I do. I mine's a little too gray at this point.
Well, we always talk about how we match when we
Yeah, true.
occasionally dress alike, but if we both had beards, it would be a little bit weird too. So
Yep, yep.
what's going
So yeah, so what shall we talk about today, Steve? It seems like this salt tax workaround is um, a topic we've talked about it at our staff meetings where we kind of get together and collaborate on news.
yeah.
Um, I don't know, maybe 4 months ago, maybe even more than that, when the IRS kind of approved this thing. But now California has put something in place for this, so now it's a relevant topic, and I think we ought to really dig into it as a firm and make sure we understand and apply it when it gets approved.
Well, I think, yeah, so taking a step back on the history of this. So when the Tax Cuts and Jobs Act came out in 2018, they limited the state and local tax deduction on Schedule A to $10,000. And
Yep.
so, which hits, states like California that have a high tax rate, hits us pretty hard because that was a huge tax deduction for our clients. And at that time, I think all the states were kind of looking at these various workarounds to try to get bypass that. I know various states tried, and I think California was even looking into, hey, if you contribute to like a charitable fund that we set up, that will you'll get a credit back on your individual return for that. And the IRS full on put the nix that plan for
Yeah.
sure.
Put the kibosh on it, I think is what you were going to say.
Yeah, I was thinking about that. I kind of went both
Yeah.
ways on that, and I decided to settle with the nix that plan. But you're right.
Yeah. But it is an interesting that was an interesting idea. I mean, it's kind of funny to think of a government splitting off their operations into a charitable arm and then a government arm so that their citizens can out of the kind of charitable nature with donative intent make some sort of voluntary contribution to the charity that is the state of California. That felt really odd as a way to kind of obviously try and get around this limitation.
Yeah,
Not that this solution doesn't also
right,
feel like a just a blatant workaround,
right.
but it does make sense. So the what has happened is I think last year, I think it was Connecticut, if I remember this correctly, last
Okay.
year they came up with this idea where they said, okay, so for people who own pass-through businesses, so you get a K1 and you have to report that income on your personal tax return. People who are shareholders or partners in pass-through businesses, instead of just flowing through that income, if the state taxes that income at the entity level instead of flowing it through, then that amount could be deductible against, at that time, I think the way this was, that amount would be deductible against the income of the entity. And therefore, it would have effectively provided a deduction in excess of that $10,000 limit on state taxes.
Yeah,
And so the IRS has actually said, I think it was at the end of last year, the IRS said, "Yep, we agree. This is doable."
Which is surprising that I thought for sure they would be like, this is another scheme to get around the $10,000 limit. It's surprising that they kind of approved this.
Yeah, and I think the reasoning was the Tax Cuts and Jobs Act specifically limits the deduction for personal taxes, and I think it's the language, without having read it, the language specifically does not limit this. There's no limit on businesses and
Right.
business taxes.
Yeah.
So the IRS, although I'm sure they understand, yeah, this is just like a technicality and a way to kind of get around this rule.
Right.
They feel that their hands are tied by the language of the law.
They must clearly feel like they couldn't win in court, or they would have challenged it, I suppose.
Right.
It kind of reminds me of like the composite returns, that people will file in other states, where you essentially, hey, I'm an out-of-state partner. I'm just going to elect to have the partnership pay my portion of that state's taxes, so that I don't have to file a return in Georgia or whatever it is. I guess the difference is, though, that they pay the taxes on your behalf, and then you just still report that on Schedule A, I think.
Right. That's
So
right.
it's not totally the same.
Right. It's more akin to withholding, like where a partnership is required to withhold on distributions made to partners or something like that.
Yeah.
So it's interesting, so the mechanics of this, the way this would work in the state of California, and I think any state doing this is probably the same way, but we're obviously very familiar with California. The way this would work is the S corporation or the partnership would elect to pay this tax on behalf of its partner or shareholder. And I personally don't know if each partner can elect whether they want to do this or not. It probably is a partner or shareholder election. And if the partner or shareholder decides to do it, then it's what, a 9.3% of whatever's reported on the K1.
Yep.
The S corp or the partnership will pay that tax and then report that on the K1, and then the partner or shareholder can take a credit for that payment on their personal tax return.
A federal credit?
No, they'll get a credit for that on their state return. So they still report the entire K1 amount, and they get a credit for that tax that was paid. So just like the withholding amount that we discussed.
Okay. Oh, I see. Yeah.
But it's a deduction. I believe it's a deduction at the entity level then. So therefore it becomes deductible.
Yeah, that's interesting. So if you had shareholders and some elected them, some of them didn't, and now it's a tax deduction, now you've got this situation, especially for an S corp, where you'd be allocating deductions amongst people that didn't pay. So
yeah. Yep. That would be an interesting issue. It probably gets treated very similar to health insurance and some of those things that get dealt with differently.
That's true. Yeah. I mean, so it looks like it's a flat 9.3%. And so, I mean, now for California, you get up to that 9.3% fairly quickly, that rate, but you don't get the advantage of the graduated rates like an individual return like you do. Well, like you do on your individual return, you wouldn't get that here. It sounds like it would just be a flat 9.3%.
Yeah, but since you're getting a credit for that tax, in the end, it doesn't really matter, right? You're going to be able to true that up on your tax return. So if your tax rate is lower or your tax rate is higher, that all gets settled up on your tax return.
Okay. Yeah.
It is interesting because I thought about that because, all right, 9.3% of your income. Yeah, that seems like a pretty good guess at where people's rates are going to be. But the difference is, if you're at a 9.3% tax rate on your California return, that's on your taxable income. After your itemized deductions and your adjustments, if you've got other losses flowing through from other entities, things like that. So it very well could be that even if you're in the 9.3% bracket, the effective rate that you're paying on your gross income would be much lower than that. And this 9.3% is on the gross income for the entity. So had this not been treated as a true up by giving the person a credit, I would struggle deciding when to recommend my clients to even do this. You'd have to figure out, okay, is this potential extra deduction worth paying the California tax at a potentially higher rate? But since it's a credit, it does work out in the end. And I, at the moment, I think I would recommend this to any client.
Yeah.
So do you have any idea? Have you seen effective dates for this?
No, I mean, it still hasn't been signed by the governor yet. So I haven't seen anything on that. But it does say for 21 through 25 tax years.
Yeah. So once this goes through, we're going to need to really publicize this to our clients and start personally reaching out to clients, I think, to make sure they're aware of it, discuss the procedures and how you elect to do this, and make sure people are taking advantage of this if they can.
Oh, great. Another change that we get to.
I knew you were going to say that.
And try to figure out.
Yeah.
I think also, just shifting gears, there's some new hiring credits I saw that are part of this bill. I mean, I think some of them extend that Main Street hiring credit I saw. So employers with 500 or fewer and a 20% decline in gross receipts from 19 to 20, they get $1,000 per net increase in full-time equivalent employees as a credit. And then I saw a new income and franchise homeless person hiring credit that's between $2,500 to $10,000 per homeless person hired, depending on the hours worked. So there's a ton of these types of credits that are available still.
Yeah. And grants, there's grants available and grants for live performance venues and things like that. That homeless person hiring credit, that seems like a great thing to do. Be interesting to understand the technicalities behind that, how you define if a new hire is eligible for that or not. That seems pretty difficult to kind of define that stuff.
Yeah, I mean, it'll be really interesting to see. As you know, I'm down at the Orange County Rescue Mission quite often, and so I got to think, they have all kinds of job programs and job searches. I got to think that they will definitely have their candidates as they go out for jobs mention that, I would hope. So
assuming their candidates would qualify, right? Because Orange County Rescue Mission, you live there for often a year. I mean, I know that they're getting jobs a lot sooner, even while they're living there going through the program. But I wonder if they qualify as homeless, right? They've got a place to stay at that point.
Well, then, I mean, if they didn't, who would?
Exactly. No, I agree. Exactly. I'm just saying that will be the interesting part about defining some of these things.
Yeah. So then, there's grants for live performance venues and whatnot. I mean, that's going to be really interesting. I mean, because we still haven't seen a lot of that come back yet. Movie theaters are opening up, but have we heard anything? Is Broadway opening? Are they open now? I mean, you were in New York and
they're not opening, I think, until September, I think I heard. So a couple of months from now. That is an interesting thing. So I was in New York last week and we had dinner with some friends that live in New York City. and just kind of asking them if things are back. And my sense from them was that people going back to work, we are way ahead of that curve here
Hmm.
than they are in New York City. I don't know if it's a all of New York versus California thing or if it's just the city. But they definitely said that midtown area where all the people work, the real estate is mostly office and commercial, and there's the theater district in that same midtown area. So that all that area is still um, down. That's what they were saying. I didn't notice it, but of course I don't know the city like that.
Yeah.
But it did feel like, a lot of people that live in New York uh, leave on the weekends. There a lot of people who can have homes out in the country and they want to get out of the city on the weekends. And um, I think a lot of people have moved into those places and not come back,
Yeah.
because they don't have to go into their office. So I do think that there's a much more permanent impact, or at least longer lasting impact in New York City than there is here.
Yeah. Yeah.
But anyway, that was a long-winded answer to say I know that there are concerts and things happening here. I mean, uh, sporting events are able to be
Yep.
sold out now.
Yeah.
Speaking of which, are you going to see your Mariners at Angel Stadium this weekend? Is it here or in Seattle?
I think it's in Seattle,
Oh, then never
so I probably won't go.
mind. Okay.
I think it is, but I'm not positive. All right, and then the last thing I had was I had a client that received a tax notice from the Franchise Tax Board. Interesting, it said the Franchise Tax Board employs security measures to protect California taxpayers and the state from tax-related identity theft. As a preventative measure, your 2020 income tax return was selected for review, and they wanted them to send in driver's license, W-2s, 1099s. It sounds like to just verify that this is the actual taxpayer, but it is interesting.
Wow. Yeah. Yeah, that's odd.
Yeah.
Did the letter make it sound like it's just a random selection?
No, it didn't. And in fact, I went online and like checked out some message boards, and there was some advice from some other, resources that we have, and they basically said, you know what, don't send in all those documents. If you, as the tax preparer who did it in 19 and 20, call in, it sounds like it's fairly straightforward. You should be able to clear it up with them without having to send in all these documents.
That's what I would do too. I would definitely not be inclined to just send info in without a return being under audit.
Yeah. So
That's
you know,
interesting.
I
Wow.
think I think the two things that I would take away for our clients would be, anytime you get tax notices, please send those over to us so we could take a look and advise you on that. Make sure that we feel like, first of all, we've seen clients in the past get what look like official documents that are from the state or from the IRS, and they aren't. So we can kind of help guide them and identify, say, that's a scam right there. They're just trying to get you to register your entity with a statement of information. So we can identify that, and then maybe we can help kind of grease the wheels and get that taken care of a lot quicker. So
Yeah, I agree. The other thing, that's an interesting thing related to identity theft. I felt like last year I had more returns rejected because returns had already been filed on their behalf, and then you have to send in the return paper file with a special form. Um, maybe I don't know when this started, maybe 5 or 8 years ago, where the IRS would send out a identity PIN number in a letter
yeah,
for taxpayers who had something like that happen in the past. So
right.
we submit that PIN number with the return when it's e-filed, and therefore the IRS kind of has at least this second verification that's accurate.
Yeah.
you can now just voluntarily get those PIN numbers. I'm starting to think that that's something that everybody ought to do.
Right. Yeah. Yeah, definitely.
Good. Well, that's good stuff. I think that, I wanted to learn more and talk more about that, especially that state tax limitation workaround, something we need to be on top of for our clients, because if it's something that is available to them, we want to take advantage of that for them. So
Yeah.
we can talk through that.
Excellent. Have a good weekend.
All right, you too.